Well, the government of Ontario is lifting the cap on post-secondary tuition as part of a major funding overhaul, a move that could raise costs for students. We are looking at how registered education savings plans can help parents prepare for this with our next guest, Tina Tehranchian, Senior Wealth Advisor at CI Assante Wealth Management Limited. Tina, thanks as always for joining us.
Thank you, Roger, for inviting me.
So they're lifting the cap. How much are they lifting the cap? And this is just an added stress for students and their parents, isn't it?
Yes, it definitely is an added stress because the cost of education, higher education, have been going up higher than inflation over the last few decades. And this will add to the stress, definitely for parents, which makes it more imperative that they use RESPs as a tool to help them save for their children's education.
Now, have RESPs gone up, or do they go up on a regular basis, the cap or the window for them?
No, it has not changed. The maximum that could be contributed to an RESP for a child is $50,000. The government pays matching grants called Canada Education Savings Grants on maximum $2,500 per year, 20% matching, so $500 grant per year, and you can carry forward only 1 year if you have not used the grant in the previous year. So you could put up to $5,000 per child and get a maximum of $1,000 grant if you have room from previous years.
Okay, so, and I guess the question, I mean, it's best then to start pretty much as soon as they're born then.
Yes, that would be the best scenario. The maximum grant that each child is entitled to over the lifetime is $7,200. So it would be best to start as soon as the children are born. And if you delay it, then make sure that you do take advantage of carry forwards.
And what's the best way to invest it? You have your choices on what you can do. You can do it with your own advisor. What do you recommend? Do you have a balance, a mixed balance? You put it all in mid, higher risk?
It really depends on the age of the child when you start the RESP. Obviously, if you start it as soon as your child is born, you have a good 17, 18 years until they start using the money. So that's a relatively long time span. And if you have the tolerance for risk, you could even invest it all in equities. If you start later, then your time horizon is going to be shorter. And again, depending on your risk tolerance, you may want to be in a balanced portfolio. The closer you get to the time that the kids need to withdraw money from the RESP, the more conservative you want to make the mix.
Now, what are some of the pitfalls and dangers you should be aware of as you're building this and as you're saving it?
Well, some of the least known things about RESPs is that people think that they can only be used for college or university education. But the good thing is that you can actually use RESPs for qualified trade programs and technical schools. So your child does not necessarily have to go to a college or university. The principal amount that you contribute to an RESP, you can take it all out tax-free because it's after-tax money that went into the RESP. What you have to be careful about are the grants and the growth on your money. So the grants can only be used if your child goes to a qualified higher educational institution. You have 35 years to use those grants. Mm-hmm. So there's a long window of time. Your child, even if they want to take time off or wait until they start their higher education, you're not going to lose the grants. And if they have siblings and your child ends up not going to any qualified post-secondary educational program, those grants and growth could be transferred to a sibling and they could be used. The worst case scenario is if your child does not go to any higher educational institution, you will have to pay the grants back to the government. You will have a choice of the post-secondary education that the grants will go to. You do have that choice when you set up the program. And any growth on the money, the accumulated income payments that have grown over the years, you have two choices. You can either withdraw it if the plan has been around for at least 10 years. You could withdraw the money. You will have to pay regular income tax plus a 20% penalty tax on it. If you have room in your RRSP account, you could transfer up to $50,000 of the accumulated income payments or the growth in your RESP funds to your RRSP and let it grow tax sheltered there and avoid paying that 20% penalty tax.
Okay, so some things you have to be. And can you use that money for expenses beyond tuition?
Yes, definitely. The only restriction is the first 13 weeks of school, you can only withdraw a maximum of $8,000 for post-secondary education. And if you're in a part-time program, you can withdraw only $4,000. After the first 13 weeks, there's no limit on the amount that you can withdraw, and you can use it for tuition, for room and board, for any purposes.
Okay, we'll have to wrap it up there, but actually, one last quick question. Is the deadline for contributing the end of February, like your RRSPs?
No, actually, it's December 31st.
Okay.
So you have until the end of the year.
Perfect. Tina, thank you as always for joining us. Appreciate it.
My pleasure, Roger. Thank you.
Tina Tehranchian is a Senior Wealth Advisor at CI Assante Wealth Management Limited.